Hi, this is Lex, and welcome to the Fintech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Hi, everybody, and welcome to today's conversation. I'm thrilled to have with us Adam Felesky, who is the CEO and co-founder of Portage. Portage is a fantastic investment firm that is focused on fintech and financial services globally with some really interesting investments that they've made in the sector. So I'm excited to talk to Adam about how he has been an entrepreneur, how he's built his career around investing, as well as what Portage sees for the future. With that, Adam, welcome to the podcast.
Thanks for having me.
My pleasure. Let's start at the beginning. What was your introduction to the industry? What pulled you into finance and tech?
Maybe starting in finance, I was that kid that back in the day read the business section every day and I was obsessed with stocks. So I just loved tickers and trying to understand what moved individual companies, and started trading stocks at a super young age. Made my dad open an account for me, quickly got obsessed, and that kind of was the genesis of trying to be around financial services as much as I could. And that led me to starting a career in investment banking, which I actually detested, and then moved to derivatives, which I loved. Was way more mathematical and interesting and actually creative. And then ultimately from that, I really got obsessed with kind of democratizing things and saw, institutional investors having so many different tools and strategies. And I was just obsessed with bringing that to the retail market. And so I was one of the first founders of an ETF business in Canada back in 2005. And so did that for a long time. And that was really my first step into being an entrepreneur.
When you were young and reading about business and trying to absorb that information, what did you feel? What about it captured you? Because it's unusual, to develop that passion so early. So what is it about stocks and the markets pulled at you, and what kind of experience did you have with it?
I guess it was just the concept that from an idea that one could create such value, and you can define value in so many different ways: value to the customer, value to yourself as an entrepreneur for building the product or service based on that idea. But it just seemed like such a mind F that just from a creative tidbit, it's possible to create $1 billion, nowadays $1 trillion company.
Yeah, that connection between the human creative force and then the abstraction of money coming together. But it's insanely hard, isn't it?
Absolutely. And I think, I started my first company when I was 28 years old. I'm always grateful that I took the leap so young because I was just so beautifully ignorant. And I think, being ignorant is really an important foundation of many entrepreneurs. I also say that, while I think I'm a pretty good investor in fintech, the one vertical I'm cautious about is around wealth management because I have so many inherent biases. So I actually think I'm a better fintech investor in other verticals because I'm more ignorant.
Interesting. Yeah, the appreciation of novelty kind of goes away when you're like, this is how things work. And then anything new is just like, that doesn't fit into the machine. Why would you put that in there? Get that out of there. That first experience founding an ETF business, you started in, I think, 2005. Can you describe what ETFs meant in 2005 and then what you saw as the entry point and the opportunity and kind of what you did?
Yeah, so at the time, there were a few ETFs largely based on the big global benchmarks, whether it was the S&P 500 or up in Canada, the TS 660. Fun fact, the first ETF ever created was up in Toronto, called the TIPS. But what I found really interesting was it actually in the mutual fund space. That's where the real momentum in indexing started to come. And you started to see more niche indexes on subsectors, including when we approached the sort of dot-com bust, there was index funds in mutual fund form where they went up when the market went down. They were called inverse funds. And I just thought that was so novel. And really, it was the trading community that was kind of the first participant or the persona of investor that really embraced this idea of not necessarily underwriting a very specific company, but having kind of micro themes within the market. And you could, more bet on subsectors or have a bias to a long position in a subsector and short the broader market. All of a sudden, there's just all this tooling that you didn't have to be, $1 billion hedge fund to explore.
I know we're going to get to all of it later, but I can't resist going there a bit now because I also grew up in wealth and investment management and spent a whole bunch of time in robo-advice and so on. I wonder, given your experience kind of riding the ETF wave, which is the first chip at making investments more liquid, making much more accessible to normal people who are just using a brokerage account and so on. It can be really psychotic almost when you are seeing the trends in multiple markets and they don't quite align. Like on the one hand, you have the wealth management story, which is like everything should be an asset allocation because that's the right way to get exposure. And for that asset allocation, everything should be optimized into an instrument like an ETF. And then if you want tilts and you want kind of micro exposure, or if you want hedging, you have other ETFs that provide you those factors, or plenty of active-ish type investing companies that let you, look at themes or whatever it is. And so there's like this one trend of the right and best way to invest is to create these asset allocations and instruments that go into them. And then at the same time, we're in a place where, the story of the angel investor and being the first person to write a check into Twitter, or the story of like the heroic crypto investor, like, oh, I invested into Bitcoin in 2010 and now I, have this empire, whatever it is also really big in the popular imagination. How do you square sort of that asset allocation training against the sort of individual private company training? Like they're so different. I wonder what you think about that.
Well, I would add maybe a third category of the day traders, of people wanting exposure to a single name. Maybe we can get to that too. The way I would square it is, my hypothesis, and I'm pretty confident in it, is that you and I and your listeners are anomalies. The vast majority of the population has no interest in financial services, are intimidated by financial services, and they need education, they need advice to enter financial services and, quite frankly, secure their financial well-being. So I think for the vast majority of the populace, one, they're probably underserved. And then two, if they're fortunate enough to find advice, it needs to be packaged and simplified in a way that meets them where they are. And I think that's why, the advisory business is still a big business. That's why the Betterments and the Wealthfronts and the Wealthsimples have been successful with a new demographic. And I think that will always still exist. But then there's this other segment of entrepreneurs and financial service junkies like you and I that love the game. And we love entrepreneurship and we love seeing company creation, and we want to be participants in that. And then the third category that I was leading to before is, and then there's, maybe people that aren't so deep in fintech or entrepreneurship, but in this day and age, we're so attached to certain brands. And, I love Adidas, so I want to own the Adidas stock. Or, I touch and I feel Apple in every part of my life. I want to have some financial compensation for being so attached to that brand. So I want to own that stock. So I think that those are kind of the ways I would square it. And I think it's okay for people to be in those different camps.
If we're adding categories, I'm going to add two more, or maybe even three more, all of which are robots. There's the BlackRock and Vanguard, the $1 trillion fund complexes, right, that rebalance the whole market. That's one. Two are the Citadels and the Virtus of the world, the companies that have replaced the exchanges in being able to extract value from the trading from capital markets, in part because of the retail brokerages. And they have absolutely amazing robots. And last, of course, like all the quant hedge funds who nip around this giant market structure as well. When you were building the ETF business, let's just close that chapter out. How big did it get? How did you go to market? And what were some of your lessons in getting that to be a good outcome?
Go to market was a lot easier back then because there just wasn't much product. There was the major ETFs covering the major indices and maybe a few of the major subsectors. And so it started with just building more coverage. And then for my company specifically at Horizons, we brought the first leveraged and inverse leverage ETFs in the world, actually. We were just ahead of the US competitor of ProShares and Ridex. So that was our original go-to-market. And like any entrepreneur, it kept evolving over the 10 years I was involved in the company. And, included the next innovation, which for us was actively manage ETFs, which is a bit of an oxymoron in itself. But essentially, certain indices on subsectors make sense. They're broad and wide and deep, and some don't. And we found a way to exploit some of those more illiquid passive indices for the benefit of active strategy. And so we brought back active management for certain strategies. So that was my journey. It kept evolving, and it ended up being a company that entered 3 different other countries, including Australia, which has become a big success. And then my journey as an entrepreneur became stale, and it was too big, and I was ready for the next thing. And so, after 10 years, that was the end of my journey, but I'm proud that that company still exists and there's still great people involved.
What did you do afterwards?
A long walk in the forest, didn't do much, really tried to be introspective in terms of what I wanted to do next. And I didn't really know. And so I felt like the best way to try and find out was to take my own capital and start surrounding myself with people like I was when I was 28 years old. So I started investing in a lot of the first young fintechs in my ecosystem. And I was fortunate enough to meet my partner through that, who was kind of on a similar journey. And then after a year or so, we decided to team up. And that was the beginning of our first fund at Portage.
What is the investment theme? Like, how did you focus? What became your selection criteria?
I was always pretty adamant that I really, really only knew fintech and financial services really, really well. And that was from being a market participant, from being an active trader, from the relationships I build. And so I felt like my alpha would only be in that vertical. So right at the outset, it was we were going to be vertically focused only on fintech. And at the beginning, what we found to be the most exciting area was in seed and Series A. And now this is back in 2012 when we were doing this in our PA to 2016 when we had our first institutional fund. And so that's where we started. And I think important at the beginning, we didn't want to be myopically focused to one market. We kind of always found that there was great entrepreneurs in fintech in different markets that had different tailwinds. Financial services is super complicated. And, the regulatory environment, as we're finding out in crypto, just is such an important catalyst, tailwind, or a negative headwind. And so that flexibility we always thought was important. So we've been fortunate to always invest around the world, concentrated in Europe and North America. And then we evolved as our companies matured. And so today we invest from seed all the way to pre-IPO with kind of probably our core assets in the Series B to C. We have moved out of our original knitting, which is fintech, and we never will.
What are some of the early companies you invested in that have done well, and what were the things that you noticed about them that motivated you to do the investment?
Our first unicorn in our portfolio actually was a Paris-based company called Alan. He had a big idea of democratizing health benefits in France specifically, and giving better service and product to entrepreneurial young SMEs in that market. And it seemed like a cool idea. And of course, we tried to validate that was a pain point. But more importantly, it was the entrepreneur himself. Jean-Charles, the CEO and founder, still to this day is one of the most interesting, dynamic founders I've met in my work in the last 8 years. And he had such focus on what the mission was and why he had to solve this pain point that he was just easy to back. You could just see that he was going to make this happen. And so that was one of our first wins. We then met a young guy in Canada named Michael Katchen, and he kind of had that similar ethos of, I need to solve this democratization of wealth management. And he was starting this small little company called Wealthsimple. That company's become a multi-unicorn. And again, it was clarity of vision. To this day, he has that same clarity and focus and ambition. The best entrepreneurs have a vision and ambition that are just so huge and potentially transformational that you can just feel it, and you can feel that determination. So that was one of our other early successes. Today we have 90 other portfolio companies, and so it's tough to tell you what my favorite child is, but we've had some great successes from Albert out in SF, Alpaca, which is an international company, and many more.
I think maybe one way is just to talk about some of these in more detail. So for example, like Wealthsimple, when was it founded? Do you remember?
2016-ish.
So, in 2016, we've got, at that point, I think already Schwab had their roboadvisor. And in the US, we had Betterment, Wealthfront, and a couple of others. Future Advisor may have already been sold to BlackRock. Wiki Invest turned into Sigfig and was deep inside UBS. I remember working with Randy Cass at Nest Wealth.
Oh, Randy. I haven't thought of that name in a long time.
I don't know how he'd feel that I'm talking about it, but, fun fact, the early version of Nest Wealth was actually running on software that I'd built and that he private labeled. And all the brokerage firms and kind of asset management firms, like, it wasn't the crypto wave yet, it was still the digital investing wave. How do you look at Wealthsimple and say, they're going to cut through this? Do you fixate on some version of, okay, this guy knows unit economics and is going to go to market and we believe he's going to grow share? Or do you see the product and say, the beta for this is so well designed, so much better than everything else? Like, what hooked you outside of kind of the thematic?
So first and foremost, the team. So I already kind of described Michael Katchen, his attributes. But importantly, at the beginning, his co-founders were perfectly complementary. So he had a sort of COO, Brett Honeycutt, who was very technical and operationally focused. And then he had a third founder, Rudy Ugler, who is a marketing genius to this day, and just had such a mind for how the brand should feel, how it should look, and how it would resonate to its target segment. And I think, segmentation and clarity of segmentation was always their strength as well. They knew very beginning who they wanted to serve and who they didn't want to serve. And they were very compelling that they would be able to identify with that segment. And we had to validate whether there was a big enough business based on who they wanted to serve, which of course we got confidence in.
How is investing different at the different stages that you've mentioned, right? So at the seed stage, it sounds like the team and conviction was it. What are the things that you look at A, at B? How does that change?
I think you've nailed it on the seed side. I think Series A, you're just looking for indication signals that there's some product market fit, and often that they've tried a bunch of different things, whether it's different segments or iterations of the product, and then they found something that's really resonated. And that typically that signal starts to come out in their various metrics or unit economics. And so you can start seeing the signs that there's a there. And in Series A, it can still be vague, and you kind of have to squint, but you should be able to start seeing that there's something. As you get B and later, really, it is more of a technical analysis and trying to understand, how much further something can scale, where's the operating leverage in the business, what are the new adjacencies to allow the ARPU or the revenue base to continue to expand, what are the different geos that they may want to consider. In B, it's often also about how are the people evolving. So you might have backed two great founders, but one founder may decide that the next part of the journey is not for him. And so we like to look at who've they attracted to the mission, because I think that's a great signal as well. And then as you get even further, it just becomes more myopically focused on the metrics and probably a little less visionary. So, I think you find investors, their own persona, fits different stages of investing. And so when we started building our team, all our partners and principals, they look very different, and it's very intentional, because I think it's really important that you have different personalities for different stages of investing.
I'm intrigued by your description of Series A traction requiring squinting. Can you give an example of what you would squint at, and then an example of where it worked out, and an example of where it did not work out? How do you get that intuition or that judgment? Maybe you could open that up.
The best example, or the easiest examples, are probably on the direct-to-consumer side, where you're so focused on customer acquisition costs and the channels in which you can pursue your customers. And Series A, you haven't had, or pre-Series A, you don't have a ton of money. So while you're testing different things, you kind of have to squint and believe in the elasticity of particularly perceived good metrics, because you really don't know if, okay, instead of this company having $500,000, now they have $5 million. Is what they're doing really scalable? And I think that's where the squinting comes in. And I'll use, actually, I think as a good example, is just robo-advice in general. I think the early unit economics of that business were pretty attractive, because there was a definite segment that was looking for the solution. But in the early days, I think that segment was relatively small. And as you tried to scale the acquisition of those customers, it became more expensive, despite the fact that the LTV of that customer is so attractive because hopefully this individual is building the retirement with you. So they'll be with you for 20, 30 years. But the problem is, the LTV of that customer is all in the terminal value. So the unit economics up front are pretty tough. So I'd say robo-advice is one where, it looked pretty good up initially, but that as you scaled, it became evident that it was a much more difficult business. I think the flip side of that would be a lot of the neobanks, and I know everyone's super negative neobanks these days, somewhat justified in some ways, but I'd say mostly unjustified in that, those unit economics for the most part have been extremely scalable. And, we found that the customers are very loyal. And if you build a new product, they will consume that product. And so your unit economics continue to improve and scale as your client loyalty continues to increase. And so we've experienced that at Albert. We've experienced that at Coho up in Canada. And I would say you didn't need to squint as much in that regard because the segment was just so massive and obvious.
What do you do when the traction that companies are bringing at seed or A is still very blurry, but the valuations are getting higher and higher? So fintech valuations in 2012, it would have been, $5 million for a seed, maybe $2 million for a seed pre-money, and then $10 million for an A, maybe $20 million. And now I'm seeing companies with a $40 million seed round, and that's not even at the high end. But the traction, what they bring to the table hasn't really changed. And a lot of that has been caused by the popularity of the sector, some of the big successes, but also the sort of mainstreaming of how to build these companies. So how do you square wanting to be disciplined and making a good investment with the market kind of shifting in terms of what it delivers at different prices?
One, you have to be disciplined. We deployed very little capital in the height of the market because we couldn't get there. I think for us, the flexibility of geography has been super important. We invested in a auto insurer in Greece, and a lot of people thought we were crazy, but they have no competition. They're the only digital insurer. We believe that they could have a top 5 market share. So, sometimes you have to find different opportunities in different markets where kind of the risk reward makes sense. We've always struggled when we're competing against investors that want to underwrite a PowerPoint at 40 million pre. We just won't get there. And that's okay. And we're going to miss some great companies, no doubt. But it's also, for the most part, kept us from some big mistakes.
Interesting. It's really tough to stay disciplined, as evidenced by a whole bunch of venture from the last 2 years getting completely blown out.
I think the other thing that for us has been great is having the flexibility of being able to do seed all the way to Series C. So different stages have different relative valuations at different times. So in the last couple of years, there's no doubt in my mind, the best stage to be an investor in venture was Series C. Those market multiples have compressed way more than seed. And so, having the flexibility to go up the maturity curve is also something that's really worked for us.
One of the things that you have to do as an investor is learn to say no. And it's this tension, right? Because as an entrepreneur, you are out in the market and selling everything to everyone until you get your first yes. And so you're constantly experiencing rejection. You come out of your entrepreneurial journey and you're like, if you become an investor, you're like, I'm going to help all these people build amazing businesses. The equation becomes completely flipped. You're like out there saying like, hey, come, I'm going to help you and fund you. And I understand your journey. And like 500 people say yes and send you their insane PowerPoint. and you have to start learning how to say no. What was that transition like for you?
I think that's a really good observation. It is a transition. And I'd say, going back to the right management team and having complementary people on the bench is no different than building a great investment team. And so I was very conscious as we build our team to have very different profiles, personas, backgrounds. And to this day, I'd say my strength is after we make an investment, given that I was an ex-operator, is kind of being in the weeds, really understanding kind of the levers with the business and working with the CEOs and management teams of where to focus and have that intensity on the things that matter. Whereas other people on my team just have an amazing eye for talent, and entrepreneurs are attracted to that person and their excitement for the idea. So I think again, it just comes back to surrounding yourself with people that are different than you and can, sometimes you can question their enthusiasm for something and vice versa. If you have those different perspectives, and importantly, you really respect each other, over time, it becomes really fluid and easy. I'm not saying there aren't certain investment opportunities that we debate and have a good arm wrestle over, but it's in our team anyways, we just really appreciate each other, and it's a debate that we all want, and when we're done it, we feel good about it. And it doesn't mean we haven't missed investments. Like, in our business, as you said, we're 80 or 90% wrong a lot. It's just once you've made the decision to invest in something, clearly you need to be more right than not. And I think that requires commitment from all your partners once the decision's made to do everything you can to make them successful.
I want to talk to you about what's going to happen in the future. 2 questions. One is around, the different fintech themes that you're looking at now. What are you seeing as being promising, interesting, and a focus of Portage? And then the second question is similarly around market structure. I know that earlier you were contemplating a SPAC structure and you're involved in kind of later stage financing for all of these companies that are trying to get through the current market environment. What's the fundamental future of the industry? And then there's what's a financial markets future look like?
Why don't I start with just fintech in general?
Yeah, let's do the fundamental one.
I mean, as you know, financial services is 20+% of global GDP. It's a massive business. I would say what we surprisingly got really wrong back in, call it 2012 to 16, was that incumbents were really ready to transform themselves. And you can divide that by vertical. In particular, that isn't true in insurance. Like these legacy businesses, in some cases, particularly as you get to health and life versus P&C, are still in yesteryear in the dark ages. They have on-prem solutions, they have data centers, and the journey to the cloud is just beginning. And here we are in 2023. So I'd say we were early on how big the incumbent transformational tailwinds would be. But sitting here today, I believe we're kind of at the cusp. If you look at banking, I'd argue, they've been ahead of insurance. There's been great migrations to solutions in banking cores, but still there's a huge wave to go. And then, of course, like, how do you ignore AI and who's got the most proprietary data sets? It's financial institutions. And I think, their urgency to get to the cloud and building, a data lake in which they can exploit their proprietary data advantage is here. And so I think that's going to be a massive catalyst. I think the other thing that's a notable change as we talk to incumbents, I should mention, we've got like 20 large global corporates that are investors in us, is, going back again to our early days when you met the CTOs of these businesses, like they were building everything themselves. And, they kind of laughed that about, a startup being able to build something as quickly or as robust or as secure as something internally. That paradigm shifted. And this idea that you can partner is very real, and it's happening in every part of financial services. And I think that's also going to be a huge accelerant of M&A, which, results in a big opportunity for investors that are investing in these young companies. And then, taking it another step back outside of just kind of incumbent transformation, there's no doubt this whole change in how we work in the distributed workforce. There's just so many opportunities that's created, whether it's how we pay people, how do we have global ERPs that work given everyone's everywhere, our customers are everywhere. It's just created a whole new stack of solutions as a result of this kind of heroic multi-generational shift. And so that's a whole new thing that didn't exist 3 years ago that is going to create extreme wealth and opportunities for certain companies. And then there's the last sort of foundational macro reality, and it's always been in place, is mobility and the fact that something like 1 billion new people through their cell phones now have access to financial services every year. And so your TAM is ever growing by massive factors. And so that was a long-winded answer to say the opportunity's never been bigger and is just getting bigger.
That's fantastic. For many reasons, I agree. I think yes and, right? Like that and even more is on the horizon. So then the second part is we do have those fundamentals, but we also have the current market environment. How do you look at risk? How do you look at where we are in the credit cycle with interest rates? And what's your view in terms of when things are going to come back?
So maybe taking a top-down view on it, there's no question, and I don't know, Lex, if you've had guests on the show talk about the denominator effect, but that's real. And it's particularly real in institutional books in Europe and the United States. And as a result, there's just less capital to be invested in private equity in general. And therefore, venture and growth as a subcomponent of private equity will have less new flow coming into it. That was true in 2022. That is true today in 2023. I think it's starting to stabilize, but I don't think we will be fully healed or be back in a market like 18, 19, 20 for a long time. The other important point and consequence of kind of the bubble that we went through, I think, is very specific to fintech. And that's why we've seen fintech suffer the most, arguably, is there were some real disasters. And I believe, and of course, I'm drinking my own Kool-Aid, that, being a generalist and doing fintech is really hard. Like, you need to know everything about a banking stack and the regulatory environment in every country that you're looking at. Insurance is completely different in a different stack, different participants and different regulators. Wealth management's got a whole different set of regulators and stakeholders. And I personally believe that there was a lot of fast capital that didn't understand those nuances. And as a result, there's been some pretty horrific experiences, particularly that got to the public markets. And so the pendulum has shifted the other way. And I think fintech will take some time to recover.
How do we get there? What are the levers to recover, you think? I've spoken with companies and just gotten such a frustrating feeling out of it. I've talked to Dave, I've talked to MoneyLion, that when they were going the SPAC route, it was clear that it was expensive, but it was expensive at the same level that venture was expensive in fintech. The SoFi story, the TransferWise story, the Robinhood story, the Coinbase story, it's just smaller versions of those things. And these companies hit the public markets. And if you look at their actual financial performance, they're putting up 20, 30% growth, steady revenue and path to profitability, in some cases, actual profitability. But their stock prices are down 95%, and it's like nobody's interested in taking those multiples from like 2 times revenue to 10 times revenue. So how do we get out of that hole? Like, are people going to look at these assets and rediscover them? Do they just have to grow into a different valuation in the current perception, or what's the path out?
I think both of those are true. I think we just need a healthier market in general, and we started to see that. I think people will always discover good value at some point. I'm a firm believer that markets are efficient, but sometimes they can be ignorant for a while. I do believe that M&A, and I've been wrong on this, to be candid, because we really have seen a dearth of M&A, but I think M&A activity is going to be part of the solution. And I also believe that, buyout's going to play a role here, that it's just going to make more sense for some of these companies to be taken out of the public markets and operate and exist in a private forum before ever returning to the public markets. And so I think as a fintech investor in the private markets, you need to bet that these companies are going to have to be private longer, because the scale for them to exist in the public markets, that threshold has just gotten a lot more significant. And I think that's what a lot of people missed is, going public seems like a great idea, but if you're kind of like on the cusp of what a mid-market cap company is, if you have any bumps in the road, all of a sudden you're irrelevant to everyone. Like, there's very few pools of capital looking for micro cap companies. And so I just think you're going to have to stay private longer. And as a result, investors are really going to have to think about how they reserve against their positions. And, we're thinking about this a lot. We used to kind of reserve $2 for every dollar we invested back, call it in Series A. I think in this new world, it may be, $3 for every dollar you invest, because you're going to have to stay private for that much longer. That probably doesn't give you a good feeling. I think it's the reality of today, and it's just going to take time to digest kind of what we've come through. The flip side is, the companies that did rise at pretty crazy valuations in the private markets, if they're growing at 50+%, the round that they do this year or in the next 12 months, hopefully can still be at a premium. That's just, if the multiples have compressed by half, but you've been growing at over 50% for 2 years, the math works. And so I think there's going to be some good opportunities for investors to invest in great companies, and they'll be excited about it because they've seen these companies mature, they've shown the growth, and they're entering at valuations that are the same as or slightly higher than they were 2 years ago, but justifiably so. And I think maybe that's what is the lubricant to getting things moving again.
Fascinating stuff. If you or Sagard decide to do a $5 to $10 billion roll up of all the neobanks and digital lenders and paytechs out in the market, I'm happy to help. It's been, I was like, I'm ready. Let's do it. Okay, we're up on time. So if our audience wants to learn more about you or about the company, where should they go?
Just go to our website, portage.com, and you can learn about all of our companies, us. Send us a note on LinkedIn, and we'll reach out.
Fantastic. Adam, thank you so much for joining me today.
Pleasure. Thanks for having me, Lex.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things FinTech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.